A $10,000 bet can become about $6,700 in 14 days when Bitcoin falls from roughly $90,000 to $60,033, while your rent, loan payment, and grocery bill still stay at 100%. The wealth plan that usually wins is the one that looks too boring to brag about: higher income, a stronger savings rate, and low-cost index funds. If your whole strategy needs one hot coin, one perfect trade, or one genius fund manager, one bad month can wipe out years of discipline and force you to sell when life is most expensive. So we are ranking 8 popular wealth-building methods by what actually matters in real life: repeatability, control, permanent damage risk, time required, and whether a normal person can stick with it when the screen turns ugly. Start with Maya, 37, in Dallas. She makes $86,000, has a 401k, a mortgage at a rate she does not love, 2 kids, and the very normal habit of checking her brokerage app in a Target parking lot like it is going to tell her whether she is winning at adulthood. In late January, she moved $12,000 from savings into crypto because the chart looked alive and every finance feed had suddenly become very confident. 2 weeks later, Bitcoin had fallen from about $90,000 to $60,033. Her $12,000 was roughly $8,000 on paper. Nothing else in her life adjusted down 33% in sympathy. Not the mortgage, not groceries, not the orthodontist estimate sitting on the counter like a small act of violence. That is the problem with most wealth advice. It shows you the up button, not the household consequences when the down button gets held for 2 straight weeks. Before ranking anything, set the rules. The question is not, can someone get rich doing this? Someone can get rich doing almost anything. Someone bought a coin early, flipped a duplex perfectly, loaded up on one stock, or built a business from a garage. Fine. Congratulations to the screenshot. The better question is, can this work repeatedly for a person with bills, limited time, imperfect emotions, and no magic ability to predict what Wall Street, the Fed, interest rates, oil prices, and internet panic will do next? That is the scorecard. Expected upside means how much money the method can make if it works. Repeatability means whether normal people can do it again without needing luck. Liquidity means whether you can get your money when life gets expensive. Behavior risk means how likely you are to panic, chase, overtrade, or talk yourself into something stupid at 11:46 p.m. Controllability means whether your effort actually improves the odds or whether you were just hoping a stranger pays more later. The 8 methods are crypto speculation, day trading and options, individual stock picking and active funds, leveraged real estate, side hustles or business ownership, raising earned income, building a strong savings rate, and low-cost index investing. The uncomfortable thesis is simple. The least impressive trio, higher income, a strong savings rate, and low-cost index funds, usually beats the methods that make the best screenshots. And yes, that is annoying because the flashy methods are built to own your attention. A green candle on a trading app feels like progress. An automatic 401k contribution feels like paperwork. A rental property spreadsheet feels like you hacked capitalism. Switching your phone plan from $95 to $45 feels like you became your own least fun parent. But wealth is not built by what feels cinematic. It is built by what survives contact with your actual life. The 2026 crypto sell-off is a clean example. Bitcoin did not drift down politely. It fell from roughly $90,000 to $60,033 between January 28th and February 11th. The Fear and Greed Index dropped to 5. Spot Bitcoin ETFs saw about $6.18 billion drain out since November. Open interest, which means outstanding leveraged market bets, collapsed 58% from its $56.6 billion peak. That sounds technical, but simply put, when everyone feels rich, people borrow, pile in, and make bigger bets. When confidence cracks, those borrowed bets get unwound fast. Prices fall harder because people are not calmly investing anymore. They are trying to get out of a crowded room through one door. So methods 1 and 2 belong together: crypto speculation and day trading or options. They look different. Crypto talks about decentralization, adoption, scarcity, and being early. Day trading talks about charts, setups, risk-reward, and discipline. Very serious, very professional, very nice font on the app. Underneath, both demand timing, emotional control, and the ability to survive large losses without needing the money. Crypto does have real upside. Some people made life-changing gains. Ignoring that would be dishonest. But a method is not judged by the person who bought early and sold perfectly.
It is judged by what happens to the person who sees the price going up, downloads the app after work, and buys, because every group chat suddenly has a market thesis. Research on crypto adoption has found that retail users often arrive after prices rise, not before. Estimates vary, but some researchers have put retail investor losses from initial crypto investments in the 73 to 81% range. That does not mean every crypto buyer loses forever. It means the typical pattern is ugly. Price rises, regular people rush in, earlier holders have someone to sell to, and the late buyer gets introduced to the word cycle in the most expensive way possible. Day trading and options take that same pressure and add a stopwatch. Every trade has friction, spreads, taxes, bad fills, platform temptation. With options, the clock is literally burning against you. You can be right about the direction and still lose because you were wrong about the timing. That is not investing. That is trying to win a bar fight with a math problem. For a normal person, with a job, a family, and a nervous system that was not designed by a hedge fund, these methods score high on upside, low on repeatability, low on calm, and very high on emotional cost. The practical rule is not never touch them. The practical rule is if you use them at all, put them in a small speculation bucket. Money you can lose without changing rent, retirement contributions, emergency savings, or in the next 3 years of real-life plans. No credit cards, no home equity line, no emergency fund, no just until it doubles. If a method can wreck your life before it proves you right, it does not belong at the foundation. Method 3 sounds more respectable. Individual stock picking and active management. This is the person at the office who does not say degen, they say quality compounder. They own a few stocks, maybe an active mutual fund, maybe a star manager with a glossy quarterly letter, and the kind of vocabulary that makes fees feel sophisticated. And to be fair, this is not meme coin roulette. Companies produce earnings. Some managers can be skilled. Some active strategies do outperform in certain markets in certain periods. Active management advocates have pushed back against popular scorecards like SPIVA, especially around methodology in certain bond categories. That caveat matters because one chart does not settle every argument.
But here is your personal problem. You still have to pick the right stock or the right manager in advance. Then you have to hold through underperformance. Then you have to know whether a rough patch is temporary or whether the edge is gone. Then you have to pay the fees either way. Recent fund flow data shows investors voting with their feet. In April, long-term active funds had a net outflow of about $21.25 billion, while long-term index funds had a net inflow of about $124.14 billion. Equity active funds alone saw about $36.29 billion leave. That does not prove every active fund is bad. It does show that millions of investors are tired of paying extra for the chance to maybe beat a benchmark that sits there, charges less, and does not give interviews about its process. Stock picking and active funds can work, but your retirement plan should not require you to identify genius before everyone else and keep faith while it looks wrong. Now, method 4, real estate. This one deserves respect and suspicion at the same time. A rental property can absolutely build wealth. You can use leverage, meaning borrowed money, to control a large asset with a smaller down payment. Tenants can help pay down the mortgage. Rents may rise. The loan balance falls while the property may appreciate. On a spreadsheet, it looks like the adult version of a money machine. Then the water heater dies. Not in the spreadsheet, in real life, on a Sunday night. The tenant has a toddler, the plumber charges emergency rates, and suddenly your passive income is wearing sweatpants in a Home Depot aisle comparing parts you did not know existed. Real estate works best when you treat it like a small business, because that is what it is. You need cash reserves, insurance, maintenance planning, local knowledge, tenant screening, rate awareness, and the emotional maturity to not buy a second property just because the first one appreciated during a forgiving market. The danger is leverage. Leverage makes good outcomes bigger, but it also makes bad outcomes sharper. If you buy too much property with too little cash, one vacancy, repair, insurance spike, property tax increase, or refinancing problem can turn an asset into a monthly cash drain. So real estate is powerful but conditional. It belongs in Tier 2, not because it is bad, but because it asks for operator skill. It's good for people with stable income, reserves, patience, and willingness to handle mess. It is dangerous for people who heard passive and thought that meant nothing breaks. Method 5. Side hustles and business ownership. This is misunderstood because it can be either a bridge or a trap. Take a household that is always $400 too tight. Driving delivery on weekends might solve a short-term problem. If it creates $600 after gas, taxes, car wear, and extra meals out because everyone's exhausted, fine. That money can rebuild the emergency fund or knock out a credit card balance. But if that becomes the whole wealth plan, the math gets rude. Trading more tired hours for slightly more money is not freedom. It is overtime with worse benefits and a louder app. Business ownership is different. A real business can create income, equity value, tax flexibility, pricing power, and optionality. That is why the ceiling is high, but the tuition is usually paid in unpaid weekends, failed offers, refund requests, awkward sales calls, platform risk, and the kind of burnout that makes a normal W-2 job start looking luxurious. Separate the two categories. A side hustle as extra cash flow can be useful. A business as an asset can be powerful. But do not confuse "I made $300 online this month" with "I own a scalable company." The strongest version is boringly practical. Use the side hustle to increase monthly investable cash first. Pay down high-interest debt, build cash reserves, fund the 401k match. Then, if there is evidence of demand, repeat customers, and pricing power, consider scaling. Now the first real winner, higher income. This one is strange because everyone says income matters, then acts like the only respectable way to build wealth is becoming a part-time portfolio manager at night. If you save $300 a month, even a great return has limited fuel. A 10% return on $300 is $30 in a year before compounding has time to become impressive. Useful, yes. Life-changing, no. If you build the skill stack to save $1,000 a month, and ordinary returns suddenly has a much larger engine. Higher income changes every calculation because it increases the amount you can invest without needing market prediction. A raise, role change, certification, sales skill, management track, trade license, coding skill, better client type, overtime with a clear purpose can all create more investable cash. The key is not just earning more, it is capturing the first year of the raise before lifestyle inflation eats it in tiny, socially acceptable bites. $180 more for the car payment because you deserve reliable transportation. $90 more for the phone plan because the device bundle sounds harmless. $70 more for subscriptions because each one is basically nothing. And $250 more in restaurant spending because you were tired and the kids will actually eat the takeout. That $8,000 raise gets mugged in the driveway before it ever reaches your brokerage account. So make higher income tactical. Before a compensation conversation, gather measurable wins, market salary ranges, and a specific ask. Not, "Can you pay me more?" Try, "Based on the revenue I supported, the projects I completed, and current market compensation for this role, I want to discuss moving my base salary to this range." If your company cannot move, set a 90-day external search target, 5 quality applications per week, 2 recruiter conversations, 1 skill upgrade tied to a job posting you actually want. Not, "Learn AI." Learn the tool, certification, software, compliance knowledge, sales script, data workflow, or management skill that appears in better paid roles. Then pre-commit the first year increase. Send 50% of the raise to automated investing or debt payoff before it touches checking. Keep some to improve life because living like a monk with Wi-Fi is not the goal. But do not let the whole raise become a nicer version of broke. Method 7. Savings rate. This is the number that sounds like a lecture until you realize it buys control. Savings rate is the gap between what you earn and what you keep. If you earn $70,000 and save 10%, that is $7,000 a year. If you move to 25%, that is $17,500 a year. The difference is $10,500 of extra annual investment fuel before the market does anything. No genius required, no Fed prediction, no newsletter, just a bigger gap. And this is where specific household choices beat motivational nonsense. Do not start with, "Stop buying coffee," like every personal finance article written by someone who has never met a stressed adult. Start with the large recurring lines: insurance, phone, car, housing, subscriptions, groceries, interest. Run a 90-minute audit. Pull the last 2 bank and credit card statements. Circle anything monthly. Then ask one question: would you actively buy this again today at this price? If the answer is no, cut or renegotiate it. Switch the $95 phone plan to a $45 plan if coverage still works in your area. Price auto and home insurance before renewal, not after it quietly jumps. Move brand name basics to store brand basics. Ibuprofen, detergent, cereal, paper towels, pantry staples. The bottle does not become financially enlightened because a national brand spent more on commercials. Use purchase timing. Buy appliances around major sale windows if the old one is limping but not dead. Delay the phone upgrade one more cycle. Replace one restaurant night with a grocery shortcut meal that is still realistic. Rotisserie chicken, bagged salad, frozen rice. Done. Not gourmet, not Instagram, also not $78 before tip. The goal is not shame. The goal is cash flow control. A strong savings rate also protects your investments. If you have cash reserves, you do not have to sell index funds, stocks, or crypto during a drawdown to handle a car repair. Cash feels boring until the market is down and the transmission fails. Then cash becomes the adult in the room. In this environment, design your cash buffer by job stability. If your income is stable and expenses are predictable, 3 to 6 months of essential expenses is a reasonable starting point. If you are self-employed, commission-based, in a volatile industry, or supporting dependents, lean higher. Keep near-term money in boring places: high-yield savings, treasury bills, money market funds, or short CDs, not in a coin, not in options, not in a temporary single-stock bet. Savings rate scores extremely high on reliability because it does not depend on a fund manager, a coin cycle, or perfect timing. It depends on decisions you can actually touch. Method 8. Low-cost index funds. Index funds win because they remove decisions that most people are not paid enough to make well. An index fund is a basket. Instead of betting your future on one company, you own tiny pieces of many companies. An S&P 500 fund owns large U.S. companies. A total market fund owns even more. The fund does not wake up trying to be brilliant. It follows the index, keeps costs low, and lets capitalism do what capitalism does: compete, fail, replace, grow, and occasionally make everyone uncomfortable. The magic is not magic. It is diversification plus low fees plus patience. Recent flows show why investors keep choosing it. In April, long-term index funds took in about $224.14 billion, while long-term active funds lost about $21.25 billion. As of March 2, 2026, Vanguard's S&P 500 ETF, VOO, had seen more than $17 billion in net flows over the prior month. Its 12-month NAV return was 16.95% as of February 28, 2026. Now, slow down here, because this is where people get sloppy. That 16.95% is not a promise. The S&P 500 can fall. It can fall hard. Indexing does not remove market risk. It removes a bunch of extra risks you do not need: manager selection risk, high fee risk, over-trading risk, and the risk that your strategy depends on you being unusually clever on a Tuesday. The tactical move is to build a default system. Capture the employer match in your 401k if you have one, use broad, low-cost, diversified funds where available, check expense ratios. If an old 401k or taxable account is full of high-fee active funds, compare them against a low-cost index alternative. In a retirement account, switching may be simple. In a taxable brokerage account, check potential capital gains before selling because taxes are also part of the return. That is account location thinking in plain English. Put the right type of investment in the right type of account and do not create a tax bill just because a cleaner spreadsheet would feel nice. If you have money needed in the next 1 to 3 years for a house, tuition, a move, or a business runway, do not put it in stock index funds and call it safe because diversified. Diversified stock risk is still stock risk. Use cash-like tools for short-term goals and index funds for long-term compounding. Now rank the 8. Tier 1 is the reliable core. Higher income, strong savings rate, and low-cost index funds. Not guaranteed, nothing honest is guaranteed, but these have the best mix of control, repeatability, liquidity, and survivability. You can work on income, you can increase the gap between income and spending, you can automate broad market investing. None of that requires you to predict whether Bitcoin bottoms on a Thursday or whether a fund manager's edge survives the next market regime. Tier 2 is powerful but conditional. Real estate and side hustles or business ownership. These can accelerate wealth when you bring skill, reserves, and patience. Real estate can work if you underwrite repairs, vacancies, insurance, taxes, and financing like an operator. Business can work if it creates repeatable profit, not just more tired hours. But both can backfire when rushed, over-leveraged, or dressed up as passive by someone selling a course from a rented kitchen. Tier 3 is speculative or expert-dependent, crypto speculation, day trading and options, and stock picking or active manager selection. These can produce winners. Of course they can. The winners are very loud and very available for podcasts. But as foundations, they are weak because you must repeatedly beat timing, fees, emotions, taxes, competition, and your own urge to do something dramatic when doing nothing would have worked better. The goal is not to avoid all risk. That is impossible. The goal is to stop making the riskiest method the foundation. So here is the 90-day plan. First, calculate your current savings rate, not vibes, actual numbers. Monthly amounts saved and invested divided by monthly take-home pay. If you bring home $6,000 and save $600, that is 10%. Pick one realistic increase for the next paycheck. Even moving from 10% to 12% matters because it turns improvement into a system. Second, protect the cash buffer. Use the 2026 market lesson correctly. When Bitcoin can drop from about $90,000 to $60,033 in 14 days, and leveraged interest can collapse by more than half, money needed soon does not belong in volatile assets. Build your emergency fund around essential expenses, not your fantasy budget. Mortgage or rent, utilities, insurance, groceries, transportation, minimum debt payments, medical basics. Third, automate the boring core before discretionary spending. 401k match first if available, then broad, low-cost, diversified funds. If you use an IRA, brokerage account, HSA, or old 401k, check the current IRS rules and contribution limits before making big moves, because limits and eligibility matter. But do not let paperwork confusion become a 6-month delay. Start with the account you already have if it offers good, low-cost options. Fourth, run the fee audit. Look at every fund you own. If the expense ratio looks high, ask what you were getting for it. Active funds saw outflows while index funds saw huge inflows for a reason. Investors are tired of paying more for uncertain benefit. If your portfolio core is expensive, concentrated, or built around a manager you cannot explain in one sentence, review it. Fifth, choose one income lever for the next 90 days, not 7, 1. a compensation conversation, a job search, a certification tied to a pay band, a higher value client offer, a sales pipeline. Overtime with a defined target, like funding the emergency account or maxing the employer match. Make the income move measurable, because work harder is just guilt wearing a tie. Sixth, cap speculation before buying. Pick a percentage, maybe 1%, maybe 5%, whatever fits your life and risk tolerance. Write it down when you are calm. The rule cannot be created while the chart is vertical and your brain is already spending imaginary profits. Seventh, make one budget substitution that will survive contact with your household. Not a punishment, a substitution. Store-brand household staples instead of premium labels. One fewer delivery order replaced by a fast grocery meal. Insurance repriced before renewal. Phone plan lowered. Gym membership paused if you have not gone since the last presidential debate. Take the savings and automate it immediately, because unassigned savings has a way of becoming tacos, convenience, and just this once. This is not glamorous. That is the point. The boring plan will not give you the biggest screenshot. It will give you fewer moments where a market crash threatens your rent, your sleep, your confidence, or your ability to keep investing when prices are down. The wealth methods that look exciting tend to demand perfect timing from imperfect humans. The methods that work best tend to ask for repeatable behavior from normal humans. Build income. Keep more of it. Let low-cost diversified funds do the compounding, and let the flashy strategies fight for whatever small speculation money is left after your real future has already been paid first.